Hello, everybody. Thanks everyone for joining this session. We're just waiting is very clear and I think very relevant in the days that we are facing today. Uh, what we are seeing today in the ecosystem in terms of startups, specifically B2B SaaS, we're seeing a lot of down rounds. We're seeing check sizes that have reduced. Popularly, what we know this particular phase as is funding winter. So we know that the funding winter is too cold today, and getting investors, closing the round in a quicker manner, getting the funds in the company for your growth, traction, certain spends that you would want to critically do. So these are things that we are currently seeing. So we're seeing VCs do have a lot of capital, but they're waiting on the fence to see where they can deploy their money and obviously get the right valuation as well. So we're seeing a lot of delays in the rounds. We're seeing lower valuation. So one needs to think about what are the alternative means that they can go through this tide. And obviously, this is a phase that is not long lasted. We obviously expect that the things will improve over a period of time, and we will see a lot of investments that will come back. So there will be a need for a bridge financing. There will be a need of some requirement of funds in the interim period. So what do companies do in this phase? Obviously, one can look at going back to their own investors, asking them for a bridge round, doing a safe convertible note. All of that is particularly okay. But again, all of that round doesn't get closed in a timely manner. So it again delays your own spends, it delays your plan in terms of how do you want to grow your company, where do you want to spend, customer acquisition becomes your large cost. So all these challenges is along the way. How do we solve the problem? So this session is primarily to uh, tackle those kind of issues. How do we solve that problem in the interim period such that the companies are able to stay afloat and do justice to their investors, also spend appropriately wherever required. Various forms of financing apart from equity, we are already aware that one can look at bank finance. Somebody can take a loan from the bank. Various form of bank funding, but we know that banks require securities. It can't be an unsecured loan. So that becomes a problem that founder may not have as much of security to pledge to get a loan. Directors themselves can obviously give loans, but that's again putting in your own capital, which is not the right situation for a funded entity. May not be the right use case as well. Other use case that we've seen on the India side, where if the companies qualify for an MSME, they can look at MSME loans. But again, the timeline that it takes, the paperwork, there are certain thresholds. How much can you raise? All that kind of is challenging, and we've not seen much MSME loans being granted to the sector that we are currently catering right now. Is B2B SaaS is what we are looking at. So we've not seen a lot of bank loans or MSME loans being granted by the banks, financial institutions, and all those things. Other alternative means that is very popular on the US side, and most of the founders who have US companies and have raised funds or maybe have revenue. So this is primarily for companies who have revenue. Can revenue be your asset class that can help you raise funds? Popularly known as revenue-based financing. This is a very common method of raising debt in the US. It's again not an equity, it's a debt, and that's why the session's name is non-dilutive. So while we are arranging a bridge, it's not going to dilute the founders. So you're not going to be worried about what is my valuation, how much am I raising, how much do I need to dilute myself, what is my ESOP, what are the other spends that I have. So it's a very committed number that you're going to raise on. It's going to depend on your future cash flows. So the best part about it is that you will share some part of your future revenues to obviously repay this loan that you've taken in terms of the debt financing that has come in your company over a period of time. And the tenure can depending on what's your need. So one needs to be very calculative in nature. It's not that you directly jump into revenue-based financing. You can obviously explore the other means of financing that's readily available of talking about bridge and other things that is required. So what do we do today is we are having Manish from Efficient Capital Labs. They've been helping a lot of founders navigate this situation. And we at AVA commonly work with a lot of SaaS driven businesses. Just a short introduction about AVA and again, Efficient Capital of what we are doing and why we are conducting this session. So at AVA, we are a transaction advisory firm and a tax advisors taking care of startups, large corporates. We have multifaceted service lines that we have. It's a 360-degree vision that we carry. So right from assurance to maybe tax advisory to transaction advisory to valuations to helping you with fundraise documentation, secretarial services. Uh, we have digital transformation as well as one of the service line virtual CFOs. I spend a lot of time doing advisory to a lot of B2B SaaS startups on the fundraise and also post fundraise, including their ESOP planning, all their cap table management, all those things. And obviously the documentation that is required all along the process of the fundraise. So we've seen multiple cycles. We've been doing in this space for the last 4 to 5 years now. So we've seen debt, we've seen equity, we've seen mix of both, we've seen revenue-based financing. Our focus on this session would be revenue-based financing. That's where we got in touch with Manish, and Manish is the co-founder of Efficient Capital Labs. They have helped many such founder-driven companies funded, raised VC capital, and were looking at some kind of solution where they can help sustain their spends over a period of maybe next 12 to 24 months. And that's where Efficient Capital has been able to kind of pull in and help maybe more than 100 plus ventures in the US and India as well today. So I believe this will be a very useful session for all of you. I would welcome again Manish to come along and just guide us. There is a small presentation that Manish will also do. But before we get to the presentation again, before Manish pitches in, what we are going to have is we're just going to run a short poll. So Mitanshu, my colleague, is with me. He's just going to just run that poll. Very basic questions, just I think just selectively answer those. What will it help us is to Manish will be able to drive the session accordingly in terms of the awareness that we're going to try to create out here. Again, just emphasizing, this is an awareness session. We're not trying to sell anything. We're not trying to overemphasize that you should look at. This is just an introduction of parallel means of financing that could be open, where some of you will be aware, many of you would have not known about this. So we'll try to give more of information. Why, what is this? How does this work? Try to solve those kind of issues. It will be a 30-minute presentation that Manish will do, and then we're open for an Q&A from all the participants that are there in the session. Happy to solve your questions on this call or virtually. If you have anything that is left over and you've not been able to answer that, we can take it offline. So over to Mitanshu first, just to run the poll, and then Manish will start his presentation to that extent. So Mitanshu, you can just run the poll.
I can't see the questions, but people are voting. Maybe it's not showing for us because we are supposed to be on. So. Yeah. We also got 58 actually. Yeah. So no. Now it's shown. We also test this out. Okay, that's the result.
Yeah, so 39. 39%, 37% are B2B SaaS businesses, 21% are B2B IT services, and 5% are B2C. And again, equal number 37% are into other businesses.
Okay, that's helpful, Mitanshu.
Yeah, so I think we have the results for the first poll, and I think significantly B2B SaaS is what we're looking at. So we got significant attendance out here. So maybe Manish, we can hand it over to you to start your session. Mitanshu will just share his screen, and then you can start talking about how does this all work about, what is this particular revenue-based financing, what's been your experience, and then we can take question and answer after the session.
Absolutely. I'll do that. Thank you so much, Lalit and Mitanshu, and thank you everyone for taking the time out for this discussion today afternoon. I hope you will find this a good use of your time. What I'm going to do in the next 20 minutes or so is to share what is our perspective on SaaS funding, and it's in turn formed from three different sources. So we look at it from a macro perspective, that is at an overall level, from a demand side as well as supply side, as in the way the capital providers think and the way the capital seekers think or are increasingly thinking. And then we'll also talk about it from a micro perspective. Towards the end of this presentation, what we'll do is we'll try to bring it all together, and hopefully you will be able to kind of form your own thesis around how you should be going about funding as a result of this presentation. I know that this says SaaS funding, but I think broadly what we say should also apply to B2B IT services to the extent that you are looking to raise capital for your IT services business. It probably will not apply for B2C businesses, particularly in India, but for other businesses, I don't know what's the nature of those businesses, but I think the principles, maybe not the sort of assertions that are there, but the principles that underline those assertions will be helpful. So I think for any business, when you are thinking in terms of funding, you can probably apply the same principles to see like how much funding you should be looking for and when and how you think about funding. So, Mithanshu, if we could move to the first slide, please. Okay, so we are going to start with a macro supply side perspective. So macro is at an overall industry level, and supply side is like how we see is how anybody who's in the business of supplying capital is thinking right now. And there was something which Lalit mentioned in his introduction to this session, and it's a term that you have been kind of hearing about a lot, especially in the last 9 to 12 months, which is funding winter. So I start my presentation by talking about it. And in fact, before I go into like what's funding winter, I'll also talk about like, okay, how does funding come into play for a pursuit such as entrepreneurship, and what role does it fundamentally play in terms of an enterprise? So if we could move to the next slide, please, Mitansh. Okay, so I'll start my presentation by asking this question and essentially making you kind of think about this, like what is common across these three activities, which are actually fundamentally very different from each other, but there's a common thread that runs across these. So one is car racing. So we are talking about like motor car racing, professional racing. The other one is bungee jumping, like an adventure sport, and entrepreneurship. Like what is common across these three activities? Now, given that I don't know, Mithanshu, if there's an easy way for people to respond to me, so I guess I'll probably also answer on people's behalf. Or is there a way that they can? Yeah, exactly. So we have somebody who kind of typed in their response. So somebody says thrill, and one person
People
has
can
said,
comment. Actually, they
Yes.
can comment in the chat box.
Yes, yes. And I am able to see that. So there's somebody has mentioned thrill, somebody has said risk. Yes, absolutely. These are the right things. There was something around lead also. I don't know, like I didn't get like what was meant by that. And there are a couple of other things coming in like awareness, etc. I'm not so sure about like if that is in context to the question that I asked, but yes, thrill is one way to kind of look at it, and risk is another way to look at it. And somebody has said safety, which is essentially the flip side of risk. Like whenever something is risky, we want to make sure that there is some safety as we undertake that risk. There are a couple of other comments coming in which are essentially about like managing risk, or taking risk which is commensurate with your risk taking capability, uncertainty about the future. I think all of these are very relevant themes. So if we could move to the next slide, please, Mithanshu. So essentially, like if I have to kind of pick a common thread across multiple comments, that is risk. Risk is nothing but uncertainty of how things will manifest themselves or how they will unfold. And essentially, when we use the term risk in common parlance, it is basically the possibility of something bad happening. So that is common across these three different activities that we have kind of listed there. But there are many such activities, and inherently, like many things that you do in life, they involve some level of risk. And you will see like why I'm starting my presentation with this thing in a moment. It will all become clear. But Mitanshu, if we could move to the next slide, please. Yeah. So what's the payback on risky activities? There was one word which came from one of the respondents, which was around thrill. So thrill is a kind of payback on a certain kind of risky activities. If we are looking at adventure sports such as bungee jumping, maybe even car racing. On some other risky activities, there is some other kind of payback. For example, somebody in their comments had mentioned high risk, high return. For example, you could argue that small cap stocks are riskier and then the return on small cap stocks is higher. You could argue that entrepreneurship is risky and then there's a payback in terms of entrepreneurship. Like if somebody is successful, then they can make it really big, and that payback is essentially monetary, maybe even status, and so on. But if we have to think of a very simple model in terms of how do we think about payback on risky activities, how do we think about it? So essentially, it's a function of two things. One is skill or luck, based on what kind of activity it is, which is essentially like how likely you are to be right? So if, for example, you are driving a fast car, how likely you are to kind of take it to the finish line without hitting other cars or without going off track. If it is entrepreneurship, it's about an exit that you could have. If it's something else, it's about like your ability to execute it if it's a skill-based thing, or your sheer luck if it's a luck-based thing. So it's about like how good you are at execution, if you like, and leverage is essentially how big of a game that you can play. For example, if you are talking about stock market investment, how much is the money that you can invest in? This is not the leverage in the financial sense where leverage can mean like how much debt you have. This is leverage as in like how big of a game that you can play. That's the sense here. So essentially, the payback is going to be a function of these two things, like how good you are and how big of a game you can play. So that's the payback on these key activities. Now, if we could move to the next slide, please. Now, in any system which is risky, if you artificially limit risk, leverage becomes more important than skill or luck. For example, if somehow you got a divine boon that no matter how badly you drive, you are always going to make your car to the finish line, what will really matter is like how big, how powerful the car is. The skill of the driver will not matter as much. And essentially bringing it to the industry that we operate in, the space that we are talking about here, capital, how do we measure risk in the financial world? The single metric for managing risk is essentially the interest rate, because interest rates essentially determine how does the market price risk. And what happened particularly after the global financial crisis until like the beginning of 2020, we had an environment where the risk was artificially limited, as in the interest rates were artificially low, by some sort of theories that some people have put it out there. Interest rates have never been that low in the last 4,000 years. Now, some of us might ask, like, how do we know what was the interest rate at the time that the pyramids were built? But that's how the industry, the sort of industry watchers kind of looked at the interest rates that we had in the last 20 years. So essentially, the point that I'm making is that we were living through extraordinary times where the risk was artificially limited, and that's why leverage became very important, more important than skill or luck. And again, to recap, leverage here is like playing a bigger game, and the skill here is like how well you play that game. If you could move to the next slide, please. Now, when we talk about funding winter, like what is funding winter from this perspective? Funding winter is nothing but leverage becoming relatively less important and back in line with historical averages. Now, those of you who have been in the entrepreneurship space for like last 6-7 years, and especially those who have not had success in raising capital, I'm sure like, in your quiet time, sometimes you have reflected that, okay, you know what, it's just become a question of how much money somebody has to burn, because if they have enough money to burn, they can sustain themselves for long enough period of time, and then that's how success was defined during this time. But the submission that I am making here is that what we call as funding winter is nothing but leverage becoming relatively less important, which by extension means that the skill factor becomes more important. And in that sense, if we could move to the next slide, please, Mithanshu. And in that sense, greater systemic appreciation of risk is a net positive for entrepreneurship. So for every single entrepreneur who's on this call, who's kind of worried about funding winter, what I want them to take away from this presentation is that this is greater systemic appreciation of risk, and it's a net positive for entrepreneurship. Sure enough, it means that we spend more time raising capitals. Those of us who may have otherwise received capital may right now not be able to receive capital. We may have to kind of spend 18 months in the raising capital as opposed to 6 months and so on. But on the whole, for entrepreneurship activity, greater systemic appreciation of risk is a net positive. So that's the first takeaway that I want you to leave with. If we could move to the next slide, please. Yeah. So here, what we are going to talk about is funding. And this slide, the coming slide, is actually very much focused on SaaS. So it's probably can also be applied to B2B IT services, but not so much to others, because here we are talking about a macro demand side perspective, and this is industry specific. So that's why, it's more relevant to B2B SaaS and B2B IT services. However, I think the thought process, the principles which kind of underpin these assertions can be applied to any other industry as well. So if we could move to the next slide, please. Okay, when we talk about SaaS businesses, what does characterize SaaS businesses? These are like three things. Of course, there are many things which are all common across SaaS businesses. I just focus on three things from a capital perspective. One is that most SaaS businesses don't operate in winner-takes-all markets. So B2B SaaS is not a winner-takes-all space. Within the same market also, you will have multiple players, but then globally, because we are talking about B2B SaaS, there will be things which are specific to a geography, there will be things which are specific to an industry and so on. So it's very rarely going to be, or probably never going to be, a winner-takes-all space in B2B SaaS, except for some areas where you do have network effects. For example, if we have to take an exception of that, so I think when we talk about LLMs, large language models, AI, etc., like those things do tend to have some network effects. Like the more data you have, more people will come to you, and the more people come to you, the more data you will have. Those are more like exceptions, but beyond that, it's not a winner takes all space. The second thing is that most SaaS businesses, even with perfect management, even with a great product, great execution, they will mature at 20 to 50 million ARR. So in a way, it's kind of derivative of point number one. But the reason I mention ARR specifically here is because your ARR, among other things, like the ARR at which a business plateaus, among other things, it should also guide your fundraising strategy. So for example, if you are a business who's going to mature at 20 million ARR, what you don't want to do is to raise your capital at a valuation of 200 million, for instance, no matter how much you get, because then when it comes to exit, then you may not be able to get that great an exit for yourself as a founder. The third thing is really important, and it applies specifically to B2B SaaS businesses. To an extent, it also applies to B2B IT services. Like these businesses can always find capital efficient playbook to grow. For example, there are things which inherently are capital efficient by definition. For example, product-led growth, which is a big tenet for SaaS companies, right? You could also have a land and expand strategy for many SaaS companies, as in you go into a company, you sell them one seat, and then over a period of time, you have 30 seats, then you have 300 seats, and so on. So likes of Zoho, etc., they do this thing, right? So SaaS, for two reasons. One, because it's a usage-based product, it's a sticky product, and as companies grow, the usage grows with that. And two, because the marginal cost of production is almost zero. So for example, if you are selling, mobile phones, then each new mobile phone. Sorry, Mithanshu, are you saying something to me? Okay.
Please carry on, Manish.
Okay. Yeah. So because the marginal cost of production for most SaaS businesses, for all the other SaaS businesses, is zero, because you are just kind of replicating a piece of code. So that is the other reason why it is so capital efficient to grow for these businesses. And these are the things, again, we'll come to like how all these things come together in a moment, but these are the things from a macro demand perspective that characterize SaaS businesses. If you could move to the next slide, please. Okay, so here what we are going to talk about, the first two perspectives were macro perspectives. They were like broad brush sort of perspectives on the industry from a capital deployment perspective and capital requirement perspective. This one is a micro perspective. This is how you probably need to think as an individual entrepreneur who's kind of, among other things, is probably looking at payback from the entrepreneurship in terms of monetary success of this of this pursuit. So, Mithanshu, if we could move to the next slide, please. Okay, so the title of this slide is, I use two words in Hindi. I assume that pretty much everyone can understand what I have said this, but if not, then essentially what we are saying here is dilution se dilution tak means like between the two dilutive events. I just took inspiration from a famous movie for the title of this slide, just so that it is a little memorable for people who kind of attend this session. But my submission here is that a startup always starts its journey with a dilutive event because you need to raise some capital to get started. Fair enough, it could be your own capital, and in that sense, it may not feel dilutive, but you are kind of, liquidating your assets in other place and kind of coming in as an investor. And it always ends with another dilutive event. So, for example, the seed round and the exit, because ultimately what you want to do is to monetize your stake in that startup. So it's that journey is between two dilutive events. That's why I call this dilution, say, dilution tak. If we could move to the next slide, please. What is success as an entrepreneur? Success as an entrepreneur, we are talking about monetary success here, is optimizing the path that is taken between these two dilutive events. Essentially, what you want to do is between these two dilutive events, you want to dilute as little as possible. You want to dilute as less often as possible, and you want to grow as much as possible, right? Essentially what you want to do is you want to make sure that you deliver the maximum bang for the buck, for lack of a better phrase, for your investors, for yourself. And that is about optimizing the path between these two dilutive events. And that optimization is always going to be industry specific. It's always going to be business specific. For some businesses, it might mean that they should raise no more than $4 million. For some businesses, maybe it's $10 million. For some businesses, maybe it's $1 million. So that's why it's a micro perspective. But you always have to think about optimizing the path that you take between these two dilutive events. If you could go to the next slide, please. To the next one, please. Yeah. So what we are doing here in this slide is just kind of recapping everything, and then we'll come to like what it means for you. So essentially three things from a macro perspective. You are likely to see a sustained reduced supply of risk capital. So in that sense, there is going to be some sustained readjustment, and it's not a seasonality. So for example, when you think of words such as funding winter, winter implies that there will be a spring, there will be a summer and autumn and so on. So I think what you are going to see at least for the next 5-6 years is sustained reduced supply of risk capital. And I think it's in our interest as entrepreneurs to adjust to that reality. The second point is, again, this is something which you saw a lot of it happening in the last few years, especially before 2023, that businesses thought that leverage in itself was a differentiation. You become so big that you become too big to fail. You raise $1 billion in capital and now you are unbeatable. You can pretty much kind of buy out competition and then there will be no one left to compete with. You can have monopolistic pricing power and so on. But I think those times are gone. And even the companies that adopted this strategy during the good times, even they are struggling right now, as you may be, kind of seeing in the news and so on. So there will be a greater appreciation of lower serviceable, obtainable markets. And as a consequence of that, there will be less external capital raised, even by the companies themselves. And from an entrepreneur's individual success perspective, what does this mean? Essentially, what this means is because the entrepreneurs are going to optimize the path between these two dilutive events, they would want to have lower dilution, and consequently, there will be a higher need for non-dilutive capital and greater optimization for cost of capital. So that's the takeaway, three takeaways that I have for you guys from this slide pack. If we could move to the next slide, please. Now you might wonder, like, where do we come into play? Like, what is it that we do, and how do we help our customers? So I'll just take like 2 minutes to talk about it. If we could move to the next one, please. Yeah, so about Efficient Capital Labs. So the business name is Efficient Capital Labs Incorporated. We are a US headquartered business. We have been in business since the beginning of 2022. What we do is we provide 100% non-dilutive capital to B2B SaaS businesses as well as B2B IT businesses, particularly those that have a recurring revenue. We can write a check of up to $2 million in less than a week. So we are very, very time efficient. We understand, like, one of the reasons people want to come to companies such as us is to optimize for the time that they have to invest in a fundraise process. So we can write a pretty meaningful check in less than a week. We provide funds in US dollars in US through our own $100 million debt facility. So we are not like an Uber of funding where we connect supply with demand. We are the supply ourselves. Till date, we have served 100 odd SaaS companies. We are very proud of that, of which I think altogether, I was just sort of looking at a slide, an internal slide. These companies are they have presence across 15 different countries, but vast majority of these companies are companies founded by Indian entrepreneurs, who are based out of India. That's a vast majority that we have catered to. And we are backed by top investors, and thanks to like their backing, we are able to solve a big problem at scale in a very fast and seamless manner. So the last round that we had, it was led by QED investors. Those of you who know QED, you will know them, that they are the top investors in the fintech space. So they are the lead investors for us, and altogether we have raised $110 million of capital in debt and equity so far. So that's about us, and I'll just pause here for any questions and answers that you may have for me.
Mitanshu, can we request to complete the polls before we launch into Q&A? That will help us get a better understanding of our audience and even from our response.
Yes. So I have just run one poll. Which course does your company have entities in? Which geography does your companies have entities in? So we have received around 14 responses, which says 43% of entrepreneurs have customer located in 50%. In fact, the customers are located in India only, followed by India plus US, and then India plus others.
Excellent.
So now it's a bit changing. We had got 18 responses, so 44% India only, India plus US 33%, and balance is India plus others. Surprisingly, we don't have anyone in who is serving India and Singapore. So I'm assuming others means other than Singapore. Yes. Can we move to next poll now?
Yes, we can. I think there's a roughly even split between India only and India plus US.
Yeah.
This question from someone also, which we'll take note of. Yes.
So next poll is, what funding stage is your startup at? Is it a bootstrapped, seed stage, Series A, and Series B plus? Majority of responses are towards bootstrapped, followed by seed stage. We have anyone for Series A or Series B plus?
I think we can move to the next question because we get an idea, like there's a roughly even split.
Yes. The next poll is, what is your annual recurring revenue range? Is it pre-revenue? Is it less than 80 lakhs or $1 lakh? It is between $80 lakh to 4 CR, which is up to $5 lakh, or it is 4 CR to 8 CR, that is $500K to $1 million, and 8 CR, 40 CR, that is 1 million to 5 million, and 5 million and above. It's 1/3 responses are towards pre-revenue, 1/3 is less than 80 lakhs, and 1/3 is between 80 lakh to 4 CR.
Okay. And there are a couple of big companies also.
Yeah. Now the poll is changed. I mean, 33% is pre-revenue, less than 80 lakhs is 25%, and less than 4 CR 25%, and less than 8 CR 8%. And we do have a company clients between 8 CR to 40 CR also 8%.
Great.
Let's move to next and last question. What forms of financing you have explored? Is it bootstrapped? I mean, you raise funds from friends and family through accelerators, early stage VCs, debt from NBFCs, and debt from banks. Yeah. So we had got 12 responses. 47% says they are bootstrapped, they are raised funds from friends and family, followed by early stage VC and debt from banks, both 16%. Then we have entities who has raised finance from accelerators and debt from NBFC, both 11% each.
Great, Mitanshu.
Yeah.
Okay.
To Q&A now.
Yeah. Shall we move to the Q&A?
Yes.
So I think there was a question that somebody had asked in the chat window, and I'll try to answer that. And meanwhile, if anybody else has any questions, please leave those in the chat window. Also, we'll answer them after answering the first one. I think somebody had asked, like, if I'm going to talk about the typical terms and what's the sort of fee associated with our product. So yes, absolutely. One, like what I'm going to tell you is there on our website also. So just in case you want to kind of refer to it after this meeting, you don't have to take any notes or anything. Just go to our website, ecaplabs.com, and you will be able to see the product. I'm going to talk about like our core product is a US dollar product, so I'll talk about that. It essentially, what's the typical product structure that we offer to our customers? It is a percentage of their revenue. If I have to give you a median value, probably around 40% of your revenue. So let's say if your revenue is 100x, we'll give you 40x. Typically, we'll give it to you for a period of 12 months, which means like you get 40x today, and then in the next 12 months, you pay for it in equal monthly installments. And again, if I have to give you a sort of pricing benchmark, then the pricing is typically between 10% to 12%. Bear in mind that pricing is something which is dynamic and it changes based on the macroeconomic conditions, uh, particularly with regards to credit. But again, if in this particular example, if we have to kind of give you an illustration, let's say you took 40x and let's say 11% is the fee, then you will have to pay 44x to us in 12 months. That is how this product is. And it usually, like, we pride ourselves on the efficiency of our process. So typically, like if you apply today, let's say on a Wednesday, you apply for funding, chances are that by next, if not next Wednesday, then maybe Thursday or Friday, we'll be able to put money in your bank account. So that's the way we work. I think uh, so. There's this question: do we do asset financing if we are planning to convert capex revenue of asset to SaaS revenue? We don't do asset financing ourselves. Asset financing has got a connotation to it, like it is a collateralized asset-backed loan. What we provide is a non-collateralized product. However, our funding is not limited to a particular purpose. So if let us say you have a revenue of $3 million and that revenue comes from a mix of like it comes in a as a service model where part of it is software and a part of it is hardware rental, then you take a let's say you take $1 million from us, like we don't care whether that $1 million goes into hiring 10 salespeople or whether it goes into lead generation, whether it goes into, you know, getting channel partnerships up and running. So we don't really care about it. It's kind of, we remain agnostic to it. But as such, we don't do something which is tied to a particular asset in the way that typically asset financing is understood. If you could scroll down. Okay.
There was one more. I mean, Mr. Ramesh had one more question. I mean, apart from typical terms, he had asked about collateral also.
Yes, we don't need any collateral, and that's one of the problems that we solve, because typically neither IT companies nor SaaS companies have any collateral, and that's the thing where our sort of underwriting capabilities kick in. Because what we have done all this time, even before the business started, but certainly after the business started, and taking I don't know, hundreds of companies through our underwriting processes, like we really understand this business, and that allows us to underwrite, as in evaluate our potential clients for their credit worthiness without the need for a collateral. So we don't require any collateral. Okay, so if I could make a quick comment based on the responses to these questions that were there. I think I saw a number of people who said that they are bootstrapped businesses, and that's how they have started. And I'll just tell everyone, particularly in this space, like especially in India, we have the whole school of thought. Like if you go to Zoho school of thought, it's about like bootstrapping is the way to build a SaaS business. So anybody who's bootstrapped either because of choice or because of necessity, don't feel bad about it. I think it's a great way to build a SaaS business. As a matter of fact, a good number of our clients are actually bootstrapped businesses, because bootstrapped doesn't mean that you don't raise external capital from any source. It just means that you are not kind of diluting as you go through the process. And SaaS businesses, for various reasons, particularly if you kind of go back to that slide, which was around like how big is the target market, and it's not a winner takes all space. And sometimes even for other reasons, which VCs will probably, not tell you like that is the reason, but maybe you are a solo founder and that's why you are not able to attract a VC. Maybe you don't have the pedigree that they are looking for. Maybe you are based out of a small town in India where you have no VC connects. There could be multitude of reasons because of which you are bootstrapped. So anybody who's building a bootstrap business, listening to this call right now, that's a great way to build a capital efficient business. And particularly SaaS businesses, B2B IT services businesses, they lend themselves very well to a bootstrap model.
Maybe Manish, they're already efficiently managing their capital. That's why they don't need external capital for themselves. That's for sure.
Yes, yes, exactly. I think there's one more question. In worst case scenario, how do you manage defaulters? So that's a very good question. So first of all, when you are in the business of lending, what you want to do is to make sure like you don't put your borrowers in a situation rather where they are unable to pay what they take from you. So part of the responsibility is with us to make sure like we don't over lever our clients. Like, we don't get anything by giving someone a sum of money which maybe they feel very happy about in the short term, and then they kind of feel burdened by it when it comes to repayment. So part of it is what we make sure like at the time of underwriting itself, like we don't over lever any of our clients. Now still it is possible that because of some sort of external event, because of some situation which is outside the control for of the founder, maybe something like a COVID or something happens, god forbid. In those situations, what we'll do is we'll work closely with people so that they are able to kind of pay back the loan. So there are things that we make sure, like for example, what we absolutely don't want to happen is like have a contractual arrangement that creates incentive for people to default because they don't want to pay back. Okay. So as far as willingness to pay is concerned, like those things, we address those things contractually. Now, when it comes to the actual business performance, etc., like if there's a situation where, that's the reason that somebody is not able to pay back the loan, then again, like any lender, it's absolutely in our interest to work with the borrower to make sure like we help them bring their business back to a place where they can fulfill obligations to us as well as to any other party that they may have, including their own employees, other lenders, etc. So that's what we do. So there's a case by case sort of approach that is taken there.
Great. I think we have done with all the questions. What I think we can request the participants, if there are any questions that you feel are unanswered, you can just drop us a mail. You have Mitanshu's email ID. Mitanshu will connect you to the right people and we'll try to answer your questions. Again, just summarizing what Manish has just kind of presented and a great work that they're doing for these startups. Basically, if you're a B2B SaaS companies, you're revenue generating, irrespective whether you're bootstrap, you're a series A, you're maybe at seed stage, trying to raise your bridge, doesn't matter. If you have revenues, what you can avail, and in case there's a requirement, 40x of maybe 100x of your revenue, which is 40% of your ARR, is what is being given as a revenue-based financing from ECL. That's something that you can look at. Cost is, I think they've already indicated. All the information will be there on their website, which I think with the link that you saw from Mitanshu will have that link as well, where you can just go there and see what are the things that you can avail from that. How it helps you is in two phases. One, you're in need of capital in the stage where you are not wanting to raise Series A because you're not getting the right valuation, but you need funds for maybe hiring, for expansion, for lead generation, all of that. This would be a right form to raise for the next maybe 12 months. Or second, you want to increase your runway. Third, it could be a bridge between not just Series A and other rounds, maybe bootstrapping and seed stage also. Maybe you're already revenue generating and you need some headroom out there. Maybe revenue-based financing is the form that you should look at. Again, there is no collateral. It's already specified. There's nothing that you need to give on that side. But what you need to share would be your revenue data, because it really depends on your ARR and MRR that you're making on month basis. That's where so your asset that you are really looking at is your own revenue that you're going to make from your future subscriptions that people subscribe to your platform. So that's how you efficiently use your own revenue to generate more of revenue-based financing and taking care of your requirements in terms of business spends that you have. Uh, I believe, I think we are done with today's session. Manish, thank you for all your valuable inputs. Thank you for taking us through what you guys are doing. And I believe at this moment where we are currently positioned, it's a very noble cause. I know it's a venture that you have, but getting capital in itself during this period becomes tough. But I think great friends like you could help many startups achieve their dreams and journeys along the way. Thanks for having us, and thanks for um, making us this platform for the others also. So making them aware in terms of what they can look at from this offering that you have. And I believe any questions that are unanswered, we're happy to take it offline. People can just write to Mitanshu. We'll try to solve that at the end. Thanks, everyone.
Thank you, Lalit. Thank you, Mithanshu, and thank you, everyone.